Hello everyone. Welcome to a review of some general principles, specifically of accounting, and really we're taking this from the concept statement. So this is the overall outline where the FASB set up back when they began making accounting principles. It's been updated multiple times since then, but it becomes kind of the backbone of how the FASB makes their decisions about specific rules and about specific instances. And so this is kind of the way they do it guideline. Now the what they use is much more involved and longer, but I've condensed it down and I've tried to highlight in bold the things that I think are most important. And I want in this video to kind of go through and help that you see that, and at the same time utilize some financial statements as illustrations. So we'll use Nike, and I'll go back and forth between reading. And I encourage you to read all of this. Take some notes, make a little bit of an outline. Ask yourselves what is most important in each paragraph. Perhaps is a good way to make sure that this is sinking in. But I'm going to try to hit some highlights here. First of all, when we're talking about financial statements, the whole idea is we're reporting the financial situation. So we shorten that to call it financial reporting, financial information about an entity. So we have to know what entity we're working with, and it has to be useful to potential investors, lenders, and other creditors. Okay, those are the primary users of the financial statement. So it's investors, secondary lenders, and other creditors. Okay, they are buying stock, putting money into the business, they are starting their own business, whatever, but that's the decisions that we're trying to make. And so when we're talking about the financial information we're going to provide, it's going to be geared to helping them make decisions. Okay, so they can make money by getting dividends, interest payments, that sort of thing, quickly in there. That's why they're so interested in this information. They're particularly interested in the amount, timing, and uncertainty, meaning what could go wrong with regard to future cash inflows. What's coming into the business? Okay, what could cause it to go wrong? How much is coming in? Okay, so that's what they would be able to utilize to pay returns to the investors. That's why we're so interested in. So we want to know what accounts receivable is, because that predicts the future, okay, cash flows coming into the company. Accounts receivable represents what their customers owe them. That represents a measure of future cash flows, that inflows. That's why it's a relevant piece of information that we want to be able to see on the balance sheet. That's what that's saying. Okay. Now, there's other financial statements, right? That the future cash inflows is all of the statements are working towards that, but we also have the resources of the entity, claims against the entity, liabilities, okay, how they have discharged their responsibility to use the entity's resource. Basically, the income statement. How successful were they at being able to take the investment that was provided them by the investors, buy assets, turn it into revenues, cover the expenses, and still have some left over. That's what you mean by efficient. If they are efficient to do that, they do that with a lower cost. Okay, and so they have to be constantly paying attention to changes around them, right? That's what this paragraph kind of talks about. And we're very interested in how they do that. So as economic things change, we want to see on the financial statements how successful they are navigating higher inflation, things like that, a disaster situation. All of those have to do how they deal with new tax laws. All of that is going to be reflected in the financial statement, hopefully. Okay, so as an investor, one of the concerns I have is I have to make a decision, and I don't work at the company typically. Most investors are not going to work there. They're not there day to day. So they have what's called information asymmetry, meaning the primary user, the people that they're making investments that this is all about, don't have enough information to make decisions unless it's provided to them in the form of these financial statements. Okay, that's what these financial reports, these financial statements do. They give enough information to overcome this information asymmetry, meaning somebody inside the company has a lot more information than they do. But by communicating this in financial statements, hopefully reduce it. It's still not going to be complete. They're not going to have everything, but because they can't communicate it all, but it is going to be much more significantly reduced based on reading the financial statements. So financial statements are essential, but we are also going to deal with notes. That's a lot of explanation about what the financial statements mean, what pieces mean, what definitions were used, as well as supplementary information show how things were calculated, how things rolled over from one year to the next. All right, so that type of information is also part of the rules. The general principles say this is the kind of things that need to be in those footnotes to make it understandable to everyone. That's what notes typically are trying to do. Now, some things that come up in here, there's kind of concepts that are going to come back over and over again. First one is recognition. Herein highlighted, it is recognized when it is put on the financial statements so that it's communicated to the users. Something may be too small to be recognized. It may not fit the definition to be recognized. Those would be things that are left off or not included this year, perhaps, in the financial statements. So when we use the term recognition, we mean put it on the financial statement. So, of course, we have a definition of what our financial statements are. Balance sheet, income statement, or statement of operations, some different terminology. You also see a statement of financial position as a balance sheet. Statement of comprehensive income is not one that we have talked about before, and we will introduce in intermediate accounting as part of our general idea of accounting. And statement of cash flows, also we talked about that, and statement of changes in stockholders' equity. That's another one that we're going to dive into a little bit more than we have in earlier classes. We're going to add some complexity to each one of these as we talk about it, because we want to tell a more complete story in our financial statements. We use very simple financial statements in earlier accounting classes. We're going to have a little more complicated. Again, the idea is, though, they're going to look very similar because they have been designated as how they should work in these general principles. And of course, we want to remember some things that they said. It's you got to read the whole story. You can't look at just the income statement, just the balance sheet, and get all the information you need. Okay. Some things are more important than others. Okay. Some parts contribute and are we have interest to different people. Okay, but we really are looking for the whole thing. And the thing to remember is lots and lots of underlying data. You look at a financial statement, for instance, if we go over here and look at Nike, when you're talking about revenues, that's an aggregate of sales of shoes and all kinds of other clothing and other items over the course of an entire 12-month period, making up 51 million or 51,000 million or $51 billion in revenues. So it's a consolidation of lots and lots of information, lots and lots of individual data items. But what we're really looking at is the story, the overall story. We're much more interested, okay, in the fact that revenue was 51 billion last year and again this year, and almost no increase, basically flat, than we are in individual amounts of any individual transactions, right, as an investor. So that's massive detail. Obviously, if we gave all that detail, no one would be able to ever learn that. So it's a lot of, we've consolidated a lot of it down to just a few lines and things. Sometimes that feels like we have summarized maybe too much, but that is part of the balance between this. Okay. We also want to remember that all of these financial statements are related to each other. Changes on the income statement are also going to change the balance sheet, and vice versa. Okay. Important point. Statement of financial position does not show the value. We are not in the business of saying to stockholders, this is how much the business is worth. It certainly can help them determine what the worth is, but the worth of Nike is not the net income. It's not what money it can make for 1 year. Okay? It's not a total of their assets on the balance sheet. It's not a total of the equity on the balance sheet. It is entirely subjective and is determined by the marketplace, what individual investors are willing to buy or sell. Now, a share of stock for. So if there's 1,000 shares of stock and people are willing to buy it for $50 each, then you're saying that that company is worth $50,000. When people buy or sell Nike stock, that's what they're determining. Okay. Is the value of Nike, at least their piece, and that by definition determines the value of the whole thing. They are going to look at trends. They are going to look at relevant information, but the determining factor that is the judgment of the investor and not what we can read. We're not going to be able to point to a number and say that's what it's worth. So be careful with that. Okay. Comprehensive income is definition here, how the income statement should work out, earnings, the differentiation between revenues and gains and expenses and losses. Okay, so expenses are both subtract from owner's equity, revenues and gains add to. All right, comprehensive income is a very broad measure. These are these general ideas that are going to be, that's why we're going to have this statement of comprehensive income. It's going to be broader. It's going to include more things than the income statement. So there could be variety of terms at various places, but they have tried to narrow it down for earnings, net income, okay, for comprehensive income, that sort of thing. But it doesn't change the underlying idea of what we're trying to measure or how we're going to calculate it. So there's some difference between earnings and comprehensive income. We'll get better at that when we reach those statements. A little bit about the cash flow, investments. Now, some other definitions. Measurability. Can we measure something? How reliable can we measure the amount? Relevance. Is it relevant to, and there's another video and set of slides that also deals with this terminology. Relevance. Is it capable of making a difference in our decisions? Is it reliable? Can we trust it? to be representation, represent, oh, that's hard to say, representationally faithful, meaning does it, the number you see on the financial statement really represent what they have? Could we verify it? Could someone else cover it? Maybe we can't right now, but was it verifiable? And did they use their own personal judgment, or was it neutral? Okay, and to do that, sometimes we measure things using different attributes, meaning sometimes we measure assets based on what we paid for them, historical costs. Sometimes we show them on the balance sheet at what their current cost, what it would take to replace it, what we could sell it for, what we could get rid of, what we could collect for it, like accounts receivable, okay, or even, as we'll deal with later on, the present value of future cash flow. It's important to know which of those we're using to know which is what story we're telling, okay? Talk about the monetary unit, the idea that, and we're going to not make changes in the purchasing power, meaning we're not going to account for inflation in this class. We're going to assume that a dollar today is worth a dollar next year and the next year. Okay. We have generally been more conservative, meaning we're more particular about showing something on the financial statements that's good, like revenues, than recognizing expenses and losses, meaning we'll put an expense on the balance sheet or on the income statement, loss on the income statement, with less evidence showing that it actually happened than we would if it was a gain. So if it's most likely than not that it's going to be a loss, we'll put it on there. It has to be much more than that to be a gain, something good. Okay. So some basic idea of revenues. We'll come back as that, but those are the general principles. We'll get into more detail. Okay. And then other definitions. What is an asset? What is a liability? What's equity? Okay. What happens with each of these things? Expenses. Okay. And gains and losses. We need to know what all these are so that we're all using the same thing and giving the user some relevant information about these pieces. If they can't understand it because it's being used differently, then it's not going to be very useful for information. Now, something that we introduced back in an earlier accounting class, and that is, and we are going to see a lot more of in intermediate, and that is estimates. We will have to make estimates. We'll have to make judgments. We'll have to, look at the circumstances and try to come up with a model that shows how much we might collect, how much might be anticipated. Remember, we're trying to anticipate. We're trying to see the future in terms of cash flows. That's always going to be somewhat of an estimate. Okay, so we're going to do our very best to get all the inputs we need and do a good job of that. But we're not going to shy away from the fact that we may have to make an estimate. I mean, there are estimates all over these financial statements, all right, including what these investments are worth, how much we're going to collect for accounts receivable, okay, what the cost of these inventories are, and which inventory is obsolete and needs to be thrown away or is not worth anything anymore. All right, these operating lease right-of-use assets, we're going to find we have to estimate an interest rate in order to come up with the right number for that, or a number that's workable. Goodwill is an estimate. That's estimate of lots of other estimates go into to calculate. Okay, now there are some exact numbers. There are numbers that we probably can get down to exactly what we owe our employees at the end of the year. Although even that, some of that could be based on a bonus calculation. It could be based on what you are planning to pay out in terms of insurance claims. All of those may go into how much we're paying our employees and may have to be estimated versus your paycheck, which should be exact. Okay, and the taxes that we want to get exactly right. So we'd like to do lots of estimates. We get exact when we can. Okay, we're going to be using accrual accounting, meaning we're going to record revenues when they are earned, not when they were received, and expenses when we owe them, when we have incurred them, when we have done, used up, not when we pay them. All right, and all of these are reflected in the financial statements. So there's some key points, key principles in this review of the kind of the constitution of accounting, or the concept statements that have been published by the FASB.